look, I know one's on the one's on the Nasdaq and one's on the S&P, but it doesn't actually matter that that's the case. So what the interns did, and it was quite an interesting use of this, is that during the up phase, the interns accumulated a short micro account. See how this is a short micro account, not a macro account, not the E-mini. This is a micro account. So because they're building a position, they built a position using, and I don't know where the positions were, I'm just going to guess here, but maybe a buy trade here and a buy trade here, maybe a buy trade here, maybe another buy trade here. I'm just obviously trying to average it so that it comes out roughly about this line. And so they got 1, 2, 3, 4, maybe a buy trade here, 5, maybe a buy trade here, 6, maybe a buy trade here, 7, a buy trade, a sell trade, my mistake, sell trade here, 8, sell trade here, 9, sell trade here, 10, right? So they've averaged the position, right? So they've accumulated a short position. So they're not going to get busted if they get a little bit of a drawdown at the top edge. But once they'd accumulated their short position and it started to be the right short position, they're now all in on their short. You can see what they did. They then sold an additional full contract on the E-mini. Now, I know the sell was on the S&P here. It doesn't matter. But once the accumulation, and they were comfortable with the accumulation, in other words, it wasn't ripping against them, you can see that they then crossed into the E-mini and sold a normal position. And you can see that we got a brilliant little sell away from that narrative. Interesting, isn't it? So when they were accumulating the top edge, the deal book was sell side. The smart money was obviously a little bit against during that phase, and then it started to come in very strongly in favor here. Smart money sell side in favor here. And obviously working into that fade off of a dealer's key at the top edge level here, building a position. And now that the trade is on as an accumulation, when this bad boy starts selling off here, smart money still heavy short, then of course the momentum should now punch it. And obviously when that failed candle there becomes a real thing, it's quite clear that this becomes a momentum trade with at least a target now of this price here. And that's exactly how they traded that little phase. And you can see the story on that. Now, you might say, but why not sell it here with a, with the micros? Of course you can, but the idea is, of course, that now that the trade is right, you want to get as big a bang for your buck as possible. And putting a single contract in here saves A, commissions, B, time trying to get the sell on, whereas the accumulation was dotted around this area where we know the accumulation is the hard part, right? Agreed? The accumulation should be the hard part. But because they're trading on the micro account, they can do a lot more with an accumulation, can't they? They can muck around a bit more, get the first price wrong, because it's only 1/10 of their position at that. Yeah, it's only 1/10 of their position sizing. So they've got a lot of leeway on the micro account to get it right. By the time they finish, of course, it's the equivalent of one E-mini or 2 E-minis or whatever it is they're trying to trade, right? By the time they're finished, it's the equivalent of an E-mini or whatever. And then when they get the momentum, the accumulation right, they then switch into this and they get the big ripper to the sell side. So I just thought it was an interesting use of the accumulation process on the E-micros versus the E-mini narrative. So this might be something of interest, right? Might be something of interest for anybody that's looking at that as a possible way to explore equity trading or any of the other micro tradings. So welcome in, guys. Welcome in. Lunchtime, of course. We're going to grab a little bit of lunch and then we will get started.